Welcome to Make Your Wealth Work, a practical show for builders, entrepreneurs, and anyone who wants to think like one. I'm Jason K. Powers here with Joe Pantozzi. Today is an exciting episode, so buckle up. And joining us, we have Dr. Paul D. Mueller. Paul is a senior research fellow at the American Institute for Economic Research and serves as a research fellow and associate director for the Religious Liberty in the States Project at the Center for Religious Culture and Democracy. He previously taught economics at the King's College in New York City. Paul is also the author of the book, 10 Years Later, Why the Conventional Wisdom About the 2008 Financial Crisis is Still Wrong. So we're going to have some conversations about that. This book argues it's time to reassess the popular narrative and maybe reverse some faulty solutions before another crisis happens. Paul, thank you so much for being on. Welcome to the show.
Thank you so much for having me. Glad to be here.
Yeah, it's fun. So I love talking to you and reading the writings you put out over the past few years. You know, we've met a while back and we'll talk about that. But I've really enjoyed, since my background is in the infinite banking concept and understanding Austrian economics a little bit, and we crossed paths specifically. I don't remember how, but I believe we got an introduction, and then your background in this has been fun to kind of talk a little bit about it and have you on previous webinars, you know, as we've run into certain financial crises over the past many years in this country. So it's fun.
That's right. I think, did we talk about kind of the Silicon Valley Bank failure? I feel like
We
last time we
did.
talked, it was right around when that happened.
That's right. And the Silicon Valley Bank crisis. And that was a good one. I mean, it was kind of a mess there for a while.
Yep.
A panic. So Paul, let's go all the way back to 2008 and 2010. You know, you put out this book back then, kind of reassessing the conventional wisdom from 2008. And tell us a little bit about that and what was kind of the motive behind it, I guess, and what is your opinion of that? How do you summarize that book in under an hour, you know?
Yeah, exactly. Sure. Well, happy to talk about it. I was interested in the financial crisis because my dad works in finance. He's an investment manager. And it was a brutal year. I was just finishing up college at the time. And the narrative that a lot of people, even maybe say right of center political people, had was that markets had failed. You know, markets just collapsed. There was, rampant greed. There was all the speculation. Banks took on all this risk. And it was a failure of regulation. And if the government didn't intervene the way they did, with huge amounts of lending and bailout money and lowering interest rates dramatically, then the market was just going to collapse. It was going to be the next Great Depression. And I was skeptical of that explanation, but I didn't know why. I knew I liked markets. I didn't believe that markets were just failing the way people said, but I didn't really know how to answer it. It was very complicated. I didn't know a ton of the financial ins and outs. And so I went to graduate school not long after that in economics. And during my time there, I was reading and thinking about what happened, how the crisis played out. And then the book I wrote was really to get my own thinking straight in terms of the timeline, the events that happened, reading some number of different explanations, and trying to piece together what really happened. And, in hindsight, the 2008 financial crisis, I tend to think, is more important every year as we go forward. It was really a turning point, not just in financial markets, though it was, and we should talk about that, but I think it was a huge turning point socially and politically. I think it signaled the end of, the 90s era, early 2000s, where there was a lot of stability, a lot of growth, a lot of optimism, a lot of creativity. And the 2008 financial crisis really shook a lot of people in a lot of ways. And I really think it's coming out of that we've seen much deeper polarization in our politics. We've seen much more aggressive back and forth on social media and, radical proposals, right? You don't have a lot of proposals in the 90s about the warmth of collectivism, as Mayor Mamdani was talking about a couple weeks ago. And this had effect kind of throughout the world. It had effect on the regulatory structure. And returning to the financial side of things, as you both know, when it comes to wealth creation and investment, interest rates are incredibly important. Interest rates and inflation. And coming out of the 2008 financial crisis, we entered an era of extremely low interest rates, intentionally so, because the Federal Reserve wanted to try to reinflate the housing bubble, stimulate economic activity. So they had interest rates remarkably low for almost a decade after 2008. And that has a big effect on people's savings, right? Just, traditional bank savings or money market accounts or other sorts of things. Hard to get much of a yield when the overnight rate is less than 1%.
Yeah.
And that has effects on what the Austrians would call the capital structure, the kinds of investments that are being made in capital projects, and even companies that invest in more capital heavy enterprises, which is related to concerns today about manufacturing or decline in manufacturing in the US. It's not just a trade issue, it's an interest rate, investment, regulatory issue. Um, so anyway, maybe there are directions we want to go here, but I think it's tremendously important. And maybe to go back to answer your question briefly, the conventional wisdom, as I was alluding to, is that markets failed. Banks got out of control, they were greedy, they were unregulated, they took too much risk, and that crashed the system, and the government had to ride into the rescue. And my take is completely different from that. I think the 2008 financial crisis was a story of misregulation. That is to say, incorrect regulations. If you
Hmm.
look at the kinds of risks that banks were taking, particularly around mortgage-backed securities, when people talk about the subprime crisis or toxic MBS or mortgage-backed securities, you look at all the banks investing in this stuff, and you do a little digging and you realize that there were regulatory changes, and we can go into the details if you'd like, in the early 2000s that encouraged banks, that privileged holding mortgage-backed securities from a regulatory standpoint in terms of how much capital they had to hold. And so what you see is systemic increases in bank investment in these mortgage-backed securities because of regulations that rewarded them for doing so. So you have this, what we call kind of herd behavior or kind of groupthink. Everyone's doing the same thing. And it turns out there were a number of structural problems in the housing market, partially due to manipulated interest rates by the Federal Reserve in the early 2000s, partially due to other regulatory elements in terms of reducing underwriting standards. This started back in the 90s with the Community Reinvestment Act, and then was just kind of added to through these big kind of quasi government agencies, Fannie Mae, Freddie Mac, that buy most of the mortgages. And so they were pushing mortgage originators, those who create mortgages, to lower their underwriting standards. So normally, we think about a down payment as 20%. Well, that's a thing of history, right? By the early 2000s, it was 10%, 5%, 3%. You have variable rate interest. I mean, this is stuff that you guys probably know quite well. And so you have this significant change in the quality of mortgages, broadly speaking, that was a little bit hard to detect. It happened gradually. It wasn't visible on the surface. And of course, one of the problems is things look great when times are good, but you only understand the risks after something bad happens, after there's some
Yeah.
kind of stress on the system or some kind of crash. And so no one was observing many differences in the performance of these much lower quality mortgages that were being written and created. There was no real observable difference in terms of performance until you have a recession and you have a panic. And then it turns out, hey, the traditional 30-year, 20% down payment is a radically different story than the 3% or no percent down. They talk about ninja loans, no income, no job, no assets, approval. So all kinds of crazy stuff going on in the housing market. But again, back to the story, banks jumped in with both feet because of regulatory rules that encouraged them to do so. And then, I mean, we could walk through 2008 itself and the different interventions that the government made that I think actually created greater uncertainty that actually contributed to a deepening of the crisis that they then came in to try to fix. So
Yeah.
anyway, less than
Yeah.
an hour, but that's probably more
Yeah.
than you wanted to hear.
Yeah. Yeah. There's so much to it to kind of pull apart, that I think like you said, it's not so simple. as, oh, it was just this is the cause
That's right.
of what happened. And I mean, 2008 was such a big deal. Even for me, that's what changed my trajectory and career and endeavors to do things, because I was watching friends and family, you know, lose their homes overnight
Mm-hmm.
and lose their entire life savings. And I mean, my own mother, you know, and another friend. And then I got into real estate investing after that because I was watching a couple of friends lose their homes, and I was like, there's got to be a way to not be foreclosed on, and not even to be elusive, right? But just there's got to be some other solution. And that's how I got into it. And then fast forward, I discovered, infinite banking through the process, and here we are, right? Some 18 years later, and trying to help people understand there is more than one way to do things, than the traditional financial format, and you've got to
That's right.
understand, like you've talked about, you've got to understand what are the banks doing? It's helpful to understand what are the banks doing? How are they functioning? Where is my money going? How much am I putting money into things that I can't control, like we've talked about in the past, and all these variables. And I think people lack that education, that understanding, and we just kind of like the herd mentality, you called it,
Hmm.
just do like everybody else is doing, and we assume we're going to be okay. Yeah.
That's right. I mean, and coming out of it, there were so many opportunities as well. Like, you had to rethink how people did things, and the real estate. I mean, the real estate market was just a mess for years, and it contributes in some ways to the broader issue I was talking about, the people feeling unsettled. I mean, today there's a great deal of concern with affordability. Housing prices have, have gone up dramatically, especially post COVID. And a lot of younger people really feel iced out. And I can kind of understand that. And I recognize, again, talking with friends, I was fortunate to buy some properties between 2010 and 2020, and that worked out really well for me, in part just because of the timing, right? Like, it would be hard to
Mhm.
lose money when the housing market is bottomed out and you enter then, you, like, can't lose. And now that it's high, it's you can't win, or it's hard to win, right? Where everything is sort of priced high. And I think that kind of whiplash contributes to people feeling like the financial system is a mystery, that some people get lucky and some people don't, that there's a lack of fairness in terms of, well, some people bought their houses back when it was, $200,000 a house, and now their house is worth 400 or 500. They didn't do anything. They just got lucky. And here I am, and the house has now cost 500 and I can't afford it. And so this is why, there's all, you talked about the complication. There's all these layers that are involved. And the Austrians wrote about this at extensive length. They call it the dynamics of interventionism, where you have an intervention and it creates some different kinds of problems, and you have interventions to kind of deal with those, creates other problems. And so when the Federal Reserve was lowering interest rates, trying to reinflate the housing market in the early or the late 2000s, they weren't thinking, oh, yeah, this will probably create senses of unfairness and randomness and luck, as some people get in and some people don't. They weren't thinking about that. They didn't have that
Right.
on their minds. They were just like, okay, we got to get housing prices back up some to try to stabilize some number we're tracking. And unfortunately, that's often what happens in the policy space. And I work in the policy space, so I'll probably bring in lots of examples. But that's the concern of going in here and trying to fix something. The world tends to be much more complicated.
So do you think from 2008 to now, what, 18 years later, do you think we've gotten better?
Well, yes, I think it's hard to quantify. I think one thing about 2008 and the crisis then was there was sort of this perfect storm where you have artificially low interest rates from the Federal Reserve in the early 2000s, boosting housing prices. You have that deterioration in underwriting standards that I mentioned, reducing the quality of mortgages. And then you have this regulatory shift that encouraged banks to jump in with both feet. And so you put all that together and you get this mess. I don't think we have like a perfect storm brewing right now. There are areas of concern, commercial real estate debt. is not in good shape and hasn't been for years. And, again, I don't know if it's going to result in a crisis, but there's challenges there. We chatted earlier, I think, about Silicon Valley Bank failing and their failure. I mean, it was a kind of a rudimentary failure
Mhm.
to manage risk where they had all of these positions that they didn't hedge or insure, if you will, that lost a lot of value when interest rates rose. And so they
Mhm.
lost tons of money when the Fed raised interest rates throughout 2022 into 2023.
Mhm.
So I don't see some kind of tidal wave of problems. Our bigger issues are really, I think, government spending and government debt, and they're more fiscal in nature. And the danger is probably more about whether we can really get inflation fully under control again or not. So I think that's more likely to be the risk than some kind of massive financial crisis.
Right.
So from a man in the street perspective, every man perspective, my clients' perspective, ordinary people, folks who aren't reading periodicals, scholarly journals, who aren't enrolled in PhD or masters or even college classes on finances, and what they're seeing from a distance is creating fear in their households.
Mm,
So my role is kind of holding people's hands as they walk through uncertainty, as we say it when we're dealing with markets, holding somebody's hair while they're throwing up over the side of the boat, trying to have people calm down and say, this is not the end of the world.
right.
You have to go to work on Monday and make a living and take care of your family. Rates are going to go up, rates are going to go down. I the first one of the first houses I bought in Las Vegas, the rate was 13%. And it
Hmm.
didn't bother me that much because it was $100,000 mortgage on my house.
Mhm.
So we always talk about the relationship between rate and volume, and people agonize about rates, but there's certain things that you could do. You could wait,
Hmm.
right? You could try to accelerate your mortgage. You could put more down if that's possible. But at the end of the day, the rate is what the rate is. If the rates are sixes in mortgages today, you're either buying a house or you're not. Maybe you want to move farther away from the city. That's not easy. A lot of
Hmm.
people can't move farther away from their jobs. We're fortunate that we can work virtually, where 10 years ago, I never conceived that clients would want to work exclusively virtually until COVID proved that it was possible. So, so for me, it's dealing with people's fear and trying to reassure them. You still have the basics that you need to be successful in your life, or you have your family, you have health, you have a job, you have you have continuity, you have excellence at what you do, you have a work ethic. So let's make sure that we don't overspend. Let's not get into toxic debt. As attractive as the initial rates might be, I mean, half of the time I'm talking with people about looking at their balance sheet and saying, we have to get some of this debt down. Well, yeah, but I have to max out my 401k. Wait a minute. Time out. There's lack of balance here. So perhaps you could talk about the fear that comes from watching too many headlines, and
No,
how we can kind of talk people off the ledge.
no, that's right. I remember there's a New York Times bestseller, an interesting guy named Nassim Taleb who wrote a couple books about risk. And one of the things he said that really stuck with me, and unfortunately, I can't really follow the advice given my current job, but he said, reading the newspaper every day actually doesn't help you understand the long-term trends well. It actually gets you really caught up in the day-to-day churn and lose sight of the big picture. And I think social media is very much like that too, right? Is what is the outrage today? What's the emergency today? What's the disaster? It is good advice to focus on the things that you know and are around you and are tangible as opposed to hypotheticals and, what's going on in markets day to day. Um, I will say, and this is something, I think that we all share in common, or this view that building wealth can be very freeing, right? Certainly you can be kind of a slave to it if you're pursuing it for the wrong reasons. But the idea of building wealth is that you become a little more insulated from the day to day. You can, if you lose your job, you have some time to find another one, or if something, you have an expense that's unexpected or something doesn't turn out the way you hope, it's not like you've put all your eggs in one basket. And so this is why diversification has been the mantra in investing for forever. And I think it's still true today. And, someone I've read that part of why I bought the place where I live now, it's actually a bed and breakfast up in the mountains that I live at and run. And I read Robert Kiyosaki, the author of Rich Dad, Poor Dad, and he had another book about retire young, retire rich. And what he does in that second book that I think is so helpful is he explains the importance of courage and creativity and changing the way that you think about wealth. That most people feel trapped because of the way they think rather than because they're actually trapped, right? Where they
Mm.
don't consider certain things to be possible. They don't consider, well, that's what rich people do. I couldn't do that. Like, I couldn't go. Yeah, I'll give you an example of like how this played out to me. I remember reading the book and Kiyosaki said, yeah, borrowing money from banks to buy houses is kind of a pain and hard. It can be hard. You have to qualify, da da da. You really should borrow money from the person selling the property. Like lots of people who sell properties are willing to finance it, depending on their situation. I'm like, I've never heard of that. That's crazy. And then later this summer, I bought this place that was financed by the seller. And he was right. I mean, we put together our own note, didn't have to go through a bank. The bank would never have lent me money for this place because I had the cash, I had a job, but I bought a house in New Jersey earlier that year. They would not have let me buy an investment property in another state. They would have been like, there's no way you qualify. But the guy I was talking with, he was just like, yeah, I want to sell it. And, you've got the money for the down payment. And, we talked some and set up the terms. So anyway, so I didn't even think it was possible. I read this. I'm like, that doesn't happen. And then
Mm.
it happened. And so, Kiyosaki just talks about the importance of being open to trying things, to learning how things, and something I've talked with folks about that, again, I think you'll both appreciate is that people look at wealth as being mysterious. Some
Mhm.
people get lucky and some people don't, and some people have the high paying job and others don't. But really, wealth is kind of like a language, and in the United States, understanding the rules of the game, right? What's a 1031 exchange? What are my tax liabilities? How do I think about deferring taxes? How do I think about tax advantaged vehicles? It sounds very foreign to most people, but actually, if you spend some time studying and thinking about it, there are many ways to build wealth. But you need to understand how it works, the pitfalls, what how you can waste it or make poor choices, and all, just understand how the tax system is set up in such a way that some activity is far more profitable and beneficial than other activity. So anyway, so I kind of tell people that too, that it's not just a trick or luck. Like there's a logic to it. There's rules to it. And a big part of what we need to do is be open, creative, and willing to, take some risk and make some effort. Maybe start small, but there's a lot that can be done. Even today, even in a world that a lot of people feel is, unfair, the deck stacked against them, still tons of ways to succeed in this country.
Mhm. And I think it's a willingness to think outside the typical box, maybe. I mean, I love how you put it where wealth building is like a language, it's like
Hmm.
learning the rules around it. It's not, I don't think a millionaire was ever made just sticking it in a savings account, really. I mean, like they're doing something with the money besides just shoving it under the mattress or and I'm going to accumulate my millionaire status. It's typically not how it works. And I love that. See, you just got to think outside the box and learn the different opportunities that are within your reach, right? Or if
Yeah,
they're not, and you want to get to that reach, why don't you start working towards that so that you can get there someday, rather than saying,
exactly.
I
Well,
can't reach that
th-
top shelf. I'll never be able to reach that top shelf. Well,
right.
let's find a stepladder.
No, that's exactly right. And, I think the idea of sort of house hacking is really important of how do you use your house as an investment vehicle, right? Whether it's buying a duplex or if you're single, renting out rooms. I mean, you can make housing incredibly profitable depending on the deal and the way you set it up, that it's not just where you live, but it's something that you leverage, right? Whether it's short-term rentals or longer-term rentals, or it's a multi-unit. And even, for example, people might say, well, how on earth am I going to afford a duplex? Right? I got to save up 30,000 or 40,000, and that's going to take me years. But again, you're not thinking outside the box. It's sort of, I talked to some friends of mine at church who maybe don't earn as much. They said, look, if you find a property that you think has good fundamentals and you need to learn what that means, like, I'd loan you 50 grand to go buy a house. Like, you could raise the money. Not, and people do this with family and friends, but like, really, you can. Like, there are people
Mhm.
around you who have resources who are, would be invested in helping you out if they're confident you have put in some time to know what you're doing and you have a strategy. And obviously, you want to do that thoughtfully. But most people don't think, oh, I could have access to 20,000 or 50,000 or 80,000 just by asking some folks around me. If I've done my homework and I have a plan, you don't necessarily have to wait years
Yeah.
to accumulate that all by yourself. But again, most people, I mean, it would sounds crazy to be like, oh yeah, I'm going to go ask somebody for 50 grand, or I'm going to go like, that's just not a super common thing unless you live in a world of entrepreneurs and people who speak this language and like, oh yeah, I do deals with my buddies all the time. We set up the LLC, we do
Mhm.
whatever. For some people, it's like that's totally normal, but for most people, it's just like foreign language, foreign country,
Mhm.
and that's where you want to educate yourself and have a kind of an open mind. Well, what really can I do? And you can actually potentially do a lot relatively quickly,
Mhm. Mhm.
but you have to do your homework. That's the other piece, is you have to do your homework.
That's right. That's
So
right.
part of doing homework might be not looking at somebody else's situation and applying it to yourself.
That's right.
So this person I know makes more money than I do and is maxing out their 401k or maxing out a pension plan at their office and so forth. So I have to make that a number one priority. Wait a minute. You want a tax deduction. You're 25 years old. You're just getting out of college. You're just getting starting a family. You have a little bit of college debt or whatever. Do we even know what your tax bracket is before you make a
Right.
decision to start putting money in a tax deductible plan that you won't see for 40 years? Let's find out what your current data is and whether a tax deduction should be tops on your hit parade.
Yeah.
Let's find out if building some capital towards more immediate things that you'll need in the next few years as opposed to retirement. I'm not
Right.
saying procrastinate forever, but at least know what that tax benefit might be worth to you in dollars and cents before you pull the trigger and deprive yourself of the opportunity to pay off that college debt, to pay off that credit card debt. Let's look at the priorities and the balance that you need to create in your own home, your own family.
Yeah, that's a great point. I mean, it's hard to do in this day and age where it's really important not to try to live somebody else's life.
Mhm.
And that's what I think a lot of people are drawn to. And social media kind of fuels that, but it's always been there. But you're absolutely right. Just because your friend made a bunch of money at one point trading on Robinhood doesn't mean you should jump on and start trading on Robinhood, right? Or buying Bitcoin or whatever. I mean, again, those could be good investments, but you got to do your homework and you got to figure out your situation. And I mean, I'm sure that you talk with your clients about this all the time. I mean, the other piece is you just got to be patient. And I find for myself, again, I run in circles with entrepreneurs and friends who've done very well. And I find patience, even for me, can be a challenge of like, well,
Sure.
how do I do more this month, right? How do I
Right.
increase my net worth
Right.
over this next 6 month period, right? How do I
Mhm.
how do I move to it? And it's sort of like, that's not really how it works. Like, you gotta be patient, let your plans work, have discipline, and think in terms of years or maybe even decades, right? As
Mhm.
opposed to days or weeks or months. And again, we live in this cycle with when there is a lot of frothiness, a lot of money, and you hear the get rich quick. And some people do, right? They get lucky and so forth. It's easy to be like, okay, if I'm not a millionaire by the end of the year, I'm failing. It's like that's not really how this works. You've got to think through where you're at and where you're trying to get to and what's available to you and have a plan that involves discipline and patience.
Yeah. Well, and the term we would use is think long range, right? Which comes
Right.
out of Nelson Nash's Becoming Your Own Banker book, where it's one of the 5 rules of IBC is this think long range. We don't do a lot of big deal things on a quick get rich quick kind of this perspective, that those are dreams and those are the lucky and these kinds of things. But you really need to think long range in any type of vehicle you're using to build wealth, right? I mean, rentals, I talk to real estate investors all the time, and we talk about you're not going to get rich off of one rental. You're just not. Now, the longer you have it, the more you can generate from it, usually. And so you got to think long range. You're going to have it for a really long time so you can pay that down and make the spread, or you're going to buy multiple.
Mm-hmm.
Think long range, start stacking what you're doing. And then we talk about that in the infinite banking space, right? When you start understanding the infinite banking concept and how to utilize this properly structured whole life insurance policies, some people look at it strictly like an investment vehicle. And they're going, oh, this has a low rate of return. I'm not making any money in the first couple of years. And I'm like, well, hold on. Lots to clarify here. But that's the thing, right? It's this, I want more now anyway.
Right.
And we got to think long range.
Yeah. Well, and it's easy to think that way in terms of, it's easy to worry that you're doing something wrong. And this is why, I mean, so another point, again, I take this from Kiyosaki, but I think he's absolutely right here, is another part of building wealth and learning to achieve financial independence is really about finding people you can trust who know things you don't know, whether that's, accountant, investment advisor, life insurance. And, when you start out, you don't need a big team, but over time you want to develop a team for people to kind of reassure you. Yeah, no, this makes sense. Like, just be patient. It's working, and that, I don't know, hand holding might be a little bit pejorative, but sometimes we all need a little hand holding, right? We have those moments of doubt where, like, wait a second, what did the market do today? Or like, where are things at? And it's always helpful to have people who've been there or who are kind of know what's going on to kind of say, no, like, this is all right. It's just it's a little speed bump, but like, you've diversified, you've got these structures, here's your plan, keep working it.
Yeah.
You mentioned the word patience. And I often find that people who are way younger tend to be impatient.
Mm-hmm.
But I also find that people who are older, people in my generation, when they decide that they haven't hit the numbers that they expected to hit, that they feel like they're behind the times, behind their goal, now they become impatient. And now they say, I better make a big score so I can make up for lost time.
Dial up the risk.
It's almost never a good idea, because now you're going to start doing something that's not your comfort level. Well, I better start investing in real estate. Well, I better start investing in X. But is that something that's comfortable for you? No, but look at the numbers. Somebody else did it. Now you have to stay in your lane, stay in your comfort zone, do what's comfortable for you. I mean, if you're running, you don't know that you're running out of time, first of all.
Mm-hmm.
So you don't want to give up the good habits that you've developed over a lifetime just because you think that the number is not necessarily where it should be. So,
Right.
Yeah, and what was I going to say? Something you were talking about here's what I was going to say. In terms of pursuing wealth and financial independence, it's important to, keep in mind the good habits that you're mentioning, but also the end goal. And the end goal, I think, in part, is peace of mind. So you talk about comfort level, right? And it's sort of, I mean, I think about this, I worked on, like, had investment properties and many late nights doing crazy stuff, getting ready for renters or fixing things, and I've kind of moved past that phase in my life where now it's like, let me talk about investments that don't require me getting up at 3 a.m. or taking random calls or dreading turning my phone on and finding out there's some problem. And that's a big part. Like, it's important. And there's a season where you do that and you're like, okay, I got to go fix this plumbing issue, or I've got to go do whatever. But part of what you want to learn over time is, okay, maybe I can trade off a little bit of, okay, I'm not quite maybe at this number that I want. However, man, I'm in a good place, or like I've come a long way, and I'm not having to, worry and go out and have all of this doubt and concern. I was telling Jason earlier, I have been trading options some over the past couple of years, kind of as a hobby and for fun. And it has been fun. I've learned a lot. I've ended up making money as opposed to losing money, but man, it has added some stress to my life. In terms of things going up and down. I'm like, wait a second, no, what do I do? Did I make a bad decision? Do I stick with my strategy? And so you just got to be thoughtful about what you're going for, and that peace of mind is, I think, important to have on that priority list.
Mhm. Mhm. Know where you want to go.
Right.
Then, yeah, that's right. That's right. So, Paul, when you and I first met, it was in the context of the infinite banking concept. And tell me a little bit about what, maybe for the listener, what was it that attracted you to IBC, and why do you think that is a good way to turbocharge what you're currently doing?
Yeah. Well, I think, there's a couple angles to it. One is life insurance is an important thing in general, especially if you have a wife or children to provide for. It's something that should be part of anyone's financial plan.
Yeah.
And you can get very cheap life insurance if you're young and healthy. If you do term, that is to say, you basically there's a clock on your life insurance policy. It's 5 years, 10 years, whatever, and you pay your premiums each month, and there's some kind of benefit if you happen to die. But then when the clock runs out at the end of that 5 or 10 year policy, the policy goes away and you need to get a new policy if you want to do that. And as you get older, the policies get more expensive because you're less healthy and have less time to live. And all the premiums you've paid have just been paid, right? They're just gone. Kind of like when you pay rent on your apartment, you rent an apartment for years and it's providing you a service, but then you move and all those rental payments are gone.
Yeah.
Versus when you own a house, part of the payments that you're making, you're probably paying more than if you're renting an apartment. But part of what you're paying is you're paying interest on the loan, but you're also paying principal, and you're accumulating something that has value and that you'll hold on to over time that accumulates. And the whole life insurance policy is kind of like that, where what you're doing is you're buying life insurance. It's not as cheap as term, but that's because like it stays with you even when you stop paying, even when, things change, you're actually accumulating this life insurance benefit. But then of course, as you know, and probably as many of your listeners know, if you set up the policy in a certain way, you also can generate interest and dividends from your accumulation of this life insurance benefit. And what attracted me about it, to go back to your question, is I like having somewhere to park my money that is working for me, but I have easy access to it. And the stock market is great for long-term stuff and even for medium-term stuff, but there's risks and there's timing issues and there's tax implications when you're going to sell to pull things out. So it's a great place to invest for sure, and everyone should invest there. But it's not necessarily a great place for what we might call working capital, right? If I want to
Mhm.
buy a property in a year or 2 or 5 years, I want to have 40, 50, 60, $70,000, whatever. The stock market is not the best place necessarily to put that money because it can fluctuate a lot year to year. And over time, it's great, but it's not good for the working capital. Bank account, savings account, right? Not good. Interest rate generally is very low. Money market accounts, again, are a little bit better, but again, not great. And so what interested me about the kind of this whole life policy is that you're buying something tangible in terms of this benefit that should be a part of your plan anyway. You have access to it in terms of being able to take out loans against what you've accumulated and put in at the drop of a hat for kind of whatever you need. And then it snowballs over time, or it compounds over time. And so it made a lot of sense for me to kind of put this in my portfolio because I had properties, I'm working, I have income, I'm investing in different places, but I have cash. What do I do with it? And I'm already thinking, I want to have life insurance. And so those things kind of came together to say, this is a great thing to add to my portfolio. It's a lot more stable than the stock market. rate of return might be slightly lower in the long run. Kind of depends. We'll see. Depends what the market does, but maybe slightly lower rate, but still better than a bank account or a savings account or money market. Or, it's the highest rate or highest return you can get for stability, I think, that I've seen.
Mhm.
Then it's great from like a working capital. I want to kind of build my capacity to borrow from myself. And again, this goes to the infinite banking concept, right? You can borrow from the bank and pay 4, 5, 6, 7%. Or if you can kind of accumulate that capital yourself, then you borrow from yourself. And instead of paying 4, 5, 6% to the bank, you're basically saving that, right? You're paying yourself that as you pay it back. And so it is being your own banker in this regard, and it can save you tens or hundreds of thousands of dollars over the years, depending on how much you borrow and when you pay it back. So that's why I got involved in it. It was a great thing to add to the portfolio of, real estate and long-term market investment for retirement and, a couple other things that I do.
Mhm. Mhm. Yeah, I love the versatility of it, kind of like you're talking about. We could put money in different places. We always say, where do we warehouse our wealth? We
Mhm.
could put money in different places. And I think I'm going to use the word favorite for lack of better words, but I think my favorite feature with utilizing cash value whole life insurance that's properly structured for this maximum cash value access is the fact that grows uninterrupted. I could put my money in a money market account
Mhm.
and build it up. But if I put 30,000 in there and I need to access 20 of it, it's growing on the 10 I left in there. Right. In my policy, I'm borrowing against the cash value, and the cash value is effectively growing uninterrupted, untouched, as if I never touched it. And there's just not another vehicle out there like that.
Mm.
That'll do that for you.
Yeah, I mean, would you say that it grows uninterrupted minus the 4% or whatever you pay on the policy loan, or not even that?
Well, actually, you're using your cash values as collateral. So your
Okay.
cash doesn't leave your policy. You're using your cash values as collateral. It continues to grow in its entirety. And you're borrowing against the balance sheet of the insurance company,
Mhm.
Mm,
which when they lend you money at 4 or 5%, you're replacing the investment opportunity that they're giving up by lending you the money. So
right.
in a sense, it's like borrowing against your house, where your house appreciates regardless of whether there's a loan against it.
Mhm.
Not every
Yeah.
policy works this way. We're talking about the policies that we use. Maybe some of the older policies, maybe some of the other companies. I can't speak for them, but that's the way it works generally.
Yeah. No, that makes sense.
Well,
Yeah, and that's right. And the other piece, so this is, more of an intellectual attraction for me, but I love finance and financiers, the JP Morgans and the, Rockefellers, people who made fortunes in finance, building companies and investing in things. Um, and so I read about that, and I love the idea of being your own banker, of like the idea of funding your bank. And the reason why you have lower returns in the first several years and it looks expensive and it doesn't look that attractive is because it's your startup costs, right? You've got to capitalize, Nelson talks about this and you guys have talked about it. You have to capitalize the bank before the bank can operate and make you money. And so you're kind of capitalizing your own account here. And so I like capitalizing my own bank and look forward to making money on my own bank.
yeah, yeah. Yeah, I mean, I think we all would love to be in a position to control that banking function in our life. If we could be our own lender, borrow from ourselves, pay ourselves back, like you said, help friends out,
Hmm.
have a good place to warehouse that wealth in the interim and utilize it. Plus all the other benefits, the life insurance on the life insurance side. It's a it's a really neat vehicle, I think.
Yeah. Well, and I'm excited too about even thinking 30, 40, 50 years ahead that you have access to. So the other difference between term and the whole life with this cash value and policy loan function is that term you only get the money when you die, which means you don't get it. Your heirs get it, your children, whoever. But with these policies that are set up this way, is you're accumulating the cash value, the life benefit but you can borrow against that before you die to do whatever you want, right? Because it's your money. And so obviously that will reduce what your heirs are paid out. You know, if you have $2 million in your policy and you borrow $1 million to do something, then your heirs will get 1 million instead of 2 million. But that gives you so much more control to do things that are meaningful or important. I mean, it could be paying for end of life care, it could be spending time with your children or grandchildren. And that is also extremely attractive to have something that you have saved up for the next generation, but to have so much access and control of it, it doesn't require you to die to actually fully utilize or have access to what you've spent a lifetime preparing and building up for.
Yeah. Well, it can certainly be a good retirement income, retirement supplement when you structure it that way and plan it that way, and people will utilize it, and set up properly on an income tax-free basis at that point, so you you have all these advantages. I'm going to set this vehicle up and it's going to be growing throughout my entire life. I'm going to be able to access it, control that banking function in my life throughout my life, and then I'm going to use it for retirement. And then after I graduate, it's going to still pay something off to my beneficiaries. And
Yeah.
so how many vehicles can speak for that wide of a range of use, you know?
Well, and I think, I don't know if you ever use this analogy, but thinking about investment, the diversification we talked about, what a lot of people, what you should think about, and maybe this is more tangible for folks, is you should think about, imagine just moved into a new house that you bought, but you've done like nothing when it comes to repairs, maintenance, construction, right? You have no tools. Well, you should get a tool, right? Like you should get a hammer, right? Maybe start with a hammer. You don't need like the table saw. You don't need,
Mhm.
the level, but like there's a couple tools you want to start. And, Joe, going back to what you're talking about, like paying down debt, high interest debt, like that's kind of tool number one, and cutting back on your spending. But again, I think of the whole life insurance policy. It's a tool. It's a great tool. It's a powerful one. It shouldn't be your only tool, right? Like you should have other tools. And
Right.
part of developing is you should have a variety of things that you're using. So, I definitely don't recommend to people, even when I encourage them to go look into it or go into it, I'm like, this should not be your only thing that you're doing, right? You should have a 401k or an IRA. You should be thinking about what your debt position looks like. There's a lot of things you should be thinking about. This is a great tool when you're ready for it, and there's all this power to it. But if you don't even have a hammer, you should maybe start with a hammer
Right.
before you go to like the cool or fancier, hacksaw or whatever it is. So anyway, that might be another way to describe it of as people where you're starting, right? If you have no tools, don't worry about not having a big tool set. Like figure out what tool am I going to get next, and how do I get that tool, learn how to use it, and then what's the next tool after that, as opposed to throwing up your hands and say, okay, I don't have any tools. There's
Mhm.
nothing I can do.
That's right. That's right. Yeah, I love that. I love that perspective. Joe, anything you want to throw in?
All I keep on hearing throughout our conversation is the need to to steward our capital, to grow our capital. Nelson would always say, "Don't be afraid to," fill in the blank. Don't be afraid to think long term.
Hmm.
Don't be afraid to capitalize. Don't steal the peas. So when you build up that capital, don't just pull it out of your bank account, for example, and not pay it back. Human nature is, I'm going to pull it out and spend it. Yeah, I'll restore my savings account when I get around to it. But if I borrow money from a stranger, if I borrow money from the credit card or a bank, I pay it back. That's what I promise to do because I have integrity. But when I borrow from myself, sometimes I let myself get away with it. And so you need to capitalize and pay yourself back while you're capitalizing. And now you're going to watch your capital snowball in the right way. And having access to capital gives you access to opportunities that you wouldn't have if you had no capital. So
Right.
some of it is basic, like the hammer. I'm so glad you brought that analogy up because the hammer is an important tool. You wouldn't start a workshop without a hammer. So you have to have some basic tools. And conceptually, one of the most basic tools you can imagine is having access to capital. and controlling that capital, as opposed to having the greatest credit scoring, having $80,000 worth of credit card availability. Gee, I could borrow more. No, no, no. How about accessing it? So controlling the
Well, and just to build on that, I mean, again, what I really value about it, and kind of knew this would happen, but really feeling it now, is the freedom that comes and interacting with a lot of different people. I'm not in a wealthy neighborhood or, going to the country club. I rub shoulders with a lot of people in a lot of situations. And, money will run your life, or debt will run your life if you're not thoughtful about it. And all of a sudden you're constrained, and then you have to make poor decisions where you know, you should get an oil change on your car. Well, I don't have any money, so I'm not going to change the oil. It's like, well, that's going to work out really badly over time. Like, you need to have enough money to change the oil. Like, you need to. There's these constraints that people feel, and some of them are just in their heads, and some of them are very real, that lead you to very suboptimal places. And so it's important to have that working capital, to have savings, to think about budget, to have this freedom so that you're not just a victim or constrained, where it's like,
Mhm.
oh my gosh, I have to borrow money because this medical thing happened and I have nowhere to go, and I just have to put it on my credit card or whatever. So it's important from a freedom standpoint. And then there's all kinds of benefits that come to being able to plan long term, as opposed to, okay, I just need to figure out tomorrow. Just need to figure out tomorrow.
Mhm.
So that's a part of it. And I think what you said too about, again, good habits is a great way to put it. Something I talk with people about a little bit is the idea of lifestyle inflation,
Mm.
right? And I see this, so I was in New York for quite a while teaching in New York City, and you see this in New York City a lot, right? Where you've got one or maybe both spouses are working, and they're in the, let's say $2,500 a month apartment, and then one of the spouses gets a raise. Like, oh, we can move to the $3,000 apartment now. And then the other one gets a raise. Oh, now we can move to the Upper East Side. We'll get the 35. And so it's like, as soon as there's any improvement in their income, it's, let's get a bigger apartment, let's eat out more. It's sort of like, oh, now we can live better because we're earning more income, as opposed to, no, like, actually think about contentment in what you have, make modest improvements, right? Maybe increase your spending a little bit, but like, think about how to increase your savings
Mm.
when you get a raise. And that's
Imagine.
part of what you're talking about, the not stealing the peas. Is like, yeah, you've got access to this money now, but that doesn't mean you should use it all to
Right.
buy a big boat. I mean, again, if that's part of your plan and it works, fine, but you shouldn't just, loot the grocery store, from his analogy, because it's there or because
Mhm.
you own it.
That's right.
Right.
Yeah, that's another rule in the 5 rules of IBC, which is that upgrading when I'm not quite ready to upgrade. But I'm not going to tell the listener what it is. I'm going to tell you to go read Becoming Your Own Banker by R. Nelson Nash and learn all 5 rules, and you will understand more of what we're talking about. I think that's a wonderful wrap, Paul. How can people track you down? How can people read more about what you're putting out there? And you have some new things coming up too.
Sure. Yeah. Well, Joe was talking at one point about kind of the everyman. And it's funny you should bring that up, because the organization I work for is about speaking to the everyman and the everywoman. So it's the American Institute for Economic Research, AIER. We're based out of Great Barrington, but we write a lot on what's going on in the economy, what's going on in the political world, nuclear power, trade, interest rates. So that's where I do a lot of my work. You can find it there at AIER. We are launching a podcast that I'm hosting that is coming out here at the end of January, and it's called The Economist Next Door. And it's conversations much like this. It's a little more policy focused, but it's meant to be very conversational and accessible for people to hear about what is monetary policy, and
Mm.
like, how does it affect my life and what I do, mortgages, how does it relate to the financial crisis, or what's going on in I'm actually gonna have a conversation even today about a podcast, a little insider baseball kind of politics, but thinking through the philosophy of freedom. And there's been this tension historically of like, is freedom more important or is virtue more important? How much do I rely on reason to direct my life, and how much do I rely on tradition and custom to direct my life? And there's some deep tensions here that philosophers have wrestled with a long time. So I'm going to talk with some of my former professors about this. But anyway, the point is that this podcast is going to be out. It's meant for people just listening who want to understand a little bit what is going on with tariffs. Like, I hear a lot of different things about tariffs. Is it good for me? Is it bad for me? Is it helping manufacturing come back? what's going on in the Medicaid world. I know there's this big, beautiful bill, and I think they were cutting Medicaid spending, but like, why were they doing that? And what implications does that have? So it's meant to be very kind of tangible issues that people maybe have heard of, but just don't know that much about. And just having conversations like this to kind of unpack it. I come from a little more academic background, so I can read the statistics. I don't like doing them. I much prefer just having a conversation. Why does this matter? What does this look like? What's going on here? I used to be a professor, and so I love to explain things and help people kind of understand this world that we live in. It's complicated, but it's also beautiful and interesting, and it's good to try to understand what's going on so that we don't walk around in a fog or feel like things just are happening to us, or that we don't have any kind of agency here. I think we have a great deal of agency. And again, understanding how things work is a part of that. So sorry, I'm going on another monologue here,
Great.
but you can find my work there at AIER, The Economist Next Door. I do have a Substack, Paul D. Mueller, if you look that up there, and it's intermittent, usually book reviews and things I'm thinking about. So, and then I have a bed and breakfast in the mountains of Colorado. So if you're looking for a place to get away,
Yes.
you can look up the Abbey.
Get up to the Abbey at high altitude. I love it.
That's right. Very high altitude.
So I need to get up there myself.
This is good. I enjoyed this, and I'm so glad that you're on with us today.
Yeah, it's been fun. Thanks for having me.
Yep. All right. This is Make Your Wealth Work. Again, a big thank you to Dr. Paul D. Mueller for the conversation. If you'd like to connect with us, if you'd like help just figuring out what tools you need, like we talked about. I mean, if you're going from screwdriver to hammer to power tools, let's help you navigate that way. Or if you need the big workbench and the drawers and everything, let's help you navigate that direction. So head on over to alphaomegawealth.com/podcast to reach myself or Joe and schedule a call. Be sure to follow and subscribe so you'll never miss an episode. Leave a quick 5-star rating or review where you can, and share this with one person who needs to hear it. Until next time, you guys take care. We'll talk soon.